Most people rely on surface level numbers and think they understand what's happening. They don't. March 2026 gave us one of the most divided markets I've seen in years. And if you're only reading the top line summary, you're missing the story entirely. I'm Jovita Pinto, a Medallion Award-winning agent multiple times over here in Metro Vancouver. I work exclusively with sellers and buyers who want data, strategy, and someone who will tell them the truth, not what they want to hear necessarily, and that's exactly what we're gonna do today. Let's get into it. Before we touch a single number, we need to talk about the environment those numbers were born in, because real estate doesn't operate in isolation. A year ago, the dominant conversation was tariffs, uncertainty. Ottawa, Washington, trade policy. That cloud has lifted somewhat, but it has been replaced.
Give me a second, let me finish.
It's been replaced by something with a more direct economic impact, ongoing geopolitical conflict in the Middle East, and the ripple effect it's creating in global financial markets. Now, if you must.
Here we go again.
Here's the mechanism, and this is important for anyone trying to understand why mortgage rates aren't behaving the way you might expect given the Bank of Canada's signals. Fixed mortgage rates in Canada are tied to bond yields, but not directly to the Bank of Canada's overnight rate. When global markets escalate, investors move money into safe haven assets. That movement put upward pressure on bond yields, and when bond yields rise, fixed mortgage rates follow. This is happening right now, and it's acting as a direct tax on buyers' purchasing power, regardless of what happens domestically. The GVR's chief economist put it plainly: the conflict in the Middle East is putting upward pressure on bond yields and fixed mortgage rates, and that's creating a dampening effect heading into what should be a strong spring market. The result? A market in a holding pattern. But within that holding pattern, something fascinating is happening. Metro Vancouver recorded 2,032 residential sales in March 2026, a 2.8% decrease from 2,091 sales recorded in March 2025. On its own, that sounds like a market tracking sideways, stable, unremarkable. But context matters. That 2,032 figure sits 31.8% below the 10-year seasonal average of 2,981. So we're not in a normal spring market. We're significantly below what the city typically produces in March. Also, prices have pulled back. And let me say now, prices have not gone into a free fall. Not all sellers are panicking. And sellers who are hesitating aren't being irrational. They're doing the math for what makes sense to them. And in one segment, we're actually seeing momentum build. That's the disconnect. And to understand it, you have to stop looking at the aggregate number and start breaking it apart by property type. Let's start with the standout story of March, what I'm calling the detached awakening. Sales of detached homes in March 2026 reached 571, an 8.3% increase from the 527 detached sales in March 2025. So while the overall market is running 32% below its historical average, detached homes are actually seeing more than they did this time last year and all of the year. That is a meaningful divergence. Now, pair that with the supply side. New listings across all property types came in at 5,792, a 10% decrease compared to 6,455 properties listed in March 2025. Now, this is okay because remember, we've been running at an all-time high in inventory. Fewer sellers are now entering the market, and the detached segment is particularly constrained. The result? The benchmark price for detached homes is now at $1,854,800, representing a 1% increase compared to February of 2026. 1 month, 1% increase in a market where everyone says prices are under hot pressure. The sales to active listing ratio for detached homes sits at 11%. To put that into plain terms, for every 100 detached homes listed, 11 are actually selling each month. Technically, that still places this into buyer's market territory. Historical data suggests upward price pressure doesn't typically occur until that ratio sustains above 20%. And downward pressure sets in when it falls below 12% for an extended period of time. But here's what the ratio alone doesn't tell you. Direction matters as much as the number itself. In February, the ratio sat at 9% for detached homes, right at the edge of the danger zone where price erosion typically accelerates. 1 month later, it's at 1%. That is not a dramatic leap, but the momentum in a very specific direction matters. Think of it less like a destination and more like a speedometer. We're not at 20%. Okay, nowhere close, but we'll take the positive. And in a market with declining new listings and rising sales volume in this segment, could the runway to get there be shorter than buyers realize? What this tells me is buyers who have been sitting on the sidelines waiting for prices in detached segment to drop and fall further may be miscalculating. The inventory compression in this segment is real, and it's starting to show up in price. Now, let's look at where that pressure is being felt most acutely, the multifamily segment. Apartment sales reached 999 in March 2026, a 7.8% decrease compared to 1,084 sales recorded in March 2025. The benchmark price of an apartment or home is $706,700, representing a 0.2% decrease compared to February 2026. Attached townhome sales totaled to 446 in March 2026, a 5.5% decrease compared to 472 sales in March 2025. The benchmark price for a townhome is $1,047,100, a 0.1% increase compared to February 2026. So here's what we have. Detached prices trickling up, apartment prices trickling down, and townhomes essentially flat. This is where the bond yield story I mentioned earlier hits the hardest. Entry-level buyers and first-time investors purchasing condos almost always prefer fixed-rate mortgages. When global instability pushes those rates higher, this segment feels it first and most sharply. These buyers are the most rate sensitive in the market. The sales to active ratio for apartments is 15.7%, higher than detached, which seems counterintuitive. But remember, there is a significantly larger pool of active apartment listings. The ratio looks reasonable, but the volume isn't there. Buyers just aren't committing. Here's the question I get asked most often right now. If there is so much inventory and so few buyers, why aren't prices plummeting at a faster pace? Fair question. Let me show you the math. There are currently 14,774 properties listed for sale across Metro Vancouver, 38% above the 10-year seasonal average of 10,704. In any other market or asset class, that supply dynamic paired with sales running 32% below average would produce significant price erosion. That's just supply and demand. But here's what's different. New listings came in at 5,792 in March, a 10.3% decrease from March 2025. Sellers are not entering the market without thinking twice. They're watching it, and my assumption is especially now. Sellers keep waiting for the spring market, but is anything actually showing up, or are we just watching cherry blossoms? Shh, let's say spring market. And that seller hesitation is preventing a surge of fresh, motivated inventory. The total number of active listings is only up 1.6% from March 2025. We're not seeing a flood of new inventory. We're seeing a slow accumulation of listings that have sat, relisted, repriced. Sellers are waiting for the right price, not accepting whatever the market will bear. That tension is what's preventing a sharper correction and allowing prices to decline slowly. Okay, let's zoom in to specific areas because the regional average masks a lot of the local variation. North Vancouver is a standout this month. The composite benchmark for North Vancouver sits at $1,311,000, up 2.5% over 1 month. This is one of the strongest months over months moves we've seen for this region. I saw this in North Vancouver last month when my buyer wrote an offer on a couple of properties and ended up in multiples more than once. But we didn't let them overpay. I advised them twice to walk away. Third time's the charm? Or persistency. Anyway, detached sales there jumped 30% month over month. That market is moving. Pitt, Meadows, and Coquitlam are also showing positive momentum, particularly in the detached segment, with month over month composite gains. Vancouver East is showing resilience. Apartments in Vancouver East are up 2.5% month over month and 3% over 3 months. One of few apartment submarkets moving in the right direction. On the other side of the ledger, Vancouver West, it's a cautionary tale. The composite benchmark for Vancouver West is down 1.1% month over month, down 3.2% over 3 months, down 4.7% over 6 months, and down 9.1% year over year. And for anyone who needs the long term view reality check, the 10-year price change for detached homes in Vancouver West is currently negative 11.4%. The benchmark price for a detached home there is $2,295,000. If you purchase a typical detached home in Vancouver West a decade ago, you are sitting on a normal loss before inflation. This is not an incident of the neighborhood. It's a lesson in entry price and segment selection. Real estate does not automatically go up anywhere, everywhere, and anywhere all the time. West Vancouver tells a similar story at the luxury end. The 10-year price change for the composite benchmark in Vancouver West is negative 13.2%. These numbers don't mean that those markets are broken. They mean that buying at the peak of an asset matters in real estate just as much as any other investment. What about Burnaby? This is a Vancouver market update. Friends, if you want me to do a deeper dive into any of these market segments, including Vancouver, New West, Port Coquitlam, etc., just drop me a comment below and I'm happy to do that for you. For now, let me translate what all of this means into plain strategy. If you're a buyer, the detached market is beginning to firm up faster than the headlines suggest. If you're waiting for a significant price correction in a single family homes, the data does not currently support that narrative or that outcome, particularly for new listings in that segment that continue to decline. You may be waiting for something that doesn't arrive. The condo market, by contrast, offers real negotiations, leverage right now. Buyers in the market segment for apartments have options, time, and pricing power. Use it, but don't assume that window is permanent. If the geopolitical picture stabilizes and rates ease, that leverage, poof, disappears. Townhomes sit in an interesting middle position. Prices are essentially flat, and inventory has grown. If you're a step-up buyer who needs more space, there are deals to be found for sure, particularly in Fraser Valley. Adjacent markets also. If you're a seller, pricing and marketing is everything. Everything right now. The accumulation of stagnant inventory I referenced is almost entirely composed of properties that launched too high and refuse to adjust. Correctly priced properties are selling. Overpriced properties are sitting. The other critical point, buyers are doing their homework. They have access to the same data I'm showing you today. Coming to market with an inflated expectation tied to old comps is a strategy that will cost you time and ultimately money. The spring market is the real test. GVR's chief economist noted that a pickup in demand heading into the spring market could result in a stagnation of standing inventory, which may support prices and current levels. That's the scenario where both buyers and sellers continue to wait and the market treads water. The alternative scenario is the geopolitical resolution or meaningful rate relief, which could unlock the significant pool of sidelined demand that exists. She's in this for weeks now. Totes. They are simply waiting for a signal that the ground is stable enough to step into it. Whether that signal comes in Q2 or later in the year is not something anyone can tell you with certainty. The March numbers tell a story that is more nuanced than any single story can capture. We have a detached market building momentum, a condo market offering buyers leverage, a seller standoff, prices in a band, and a global backdrop that is actively reshaping what borrowing costs look like. For every person that is trying to make a decision, my job is to help you navigate that complexity with clarity, show you what the data actually says and what it means for a specific situation like yours. I'm Jovita Pinto. If you're thinking about buying or selling in Metro Vancouver and you want a strategy rooted in the numbers, not the antics, the link to book a strategy call is below. I'd love to dig into the specific data for your neighborhood and help you figure out exactly where you stand. If this breakdown was useful, subscribe and hit the bell. I release these monthly market updates as soon as the data drops, along with a weekly educational video. I'll see you in the next one.